helpful to you if you're starting your business. So Richard, take it away.
Thank you, Anita, and welcome everybody to this presentation on financial management. I'm going to briefly review a little bit about SCORE for those of you who haven't participated or attended in the past, and then we're going to get right into the discussion. SCORE Cleveland serves 8 counties. This is a picture of our website. So if you go to score.org/Cleveland, you come right to our website, or you can actually go to score.org and just put in the information saying, send me to Cleveland. And either way, you'll get to us. Interesting side note, you'll notice that in the upper right there, it says National Chapter of the Year in 2022. We are the district chapter of the year this year. And the district is Ohio. So we're still one of the very, very best chapters in the country. On this slide, also you can see on the blue line near the top of the screen that says local workshops. That's where you can find a calendar of all of our workshops that are coming up within the next couple of months. And local mentors, you can find a profile of every mentor in our chapter and identify, if there's anybody in the chapter that you think might be able to help you directly. And there's tremendous amount of other resources available. We have tips and tricks on all kinds of things. This is just the top of the chapter website. If you scroll down, you're going to find a tremendous amount of additional information available to you, almost anything that you want to find. So we're going to start looking at simple steps. This is the 4th section. The first one was an introduction. Second was a little bit about preparing, how to prepare yourself for your business. Are you really headed down the right road? Does it make sense? The third one was marketing. And as this shows, this is the financial plan. Just a little note for you, and that is the next session, the final session, will be next week, and it'll be on how to find funding and the resources available to you. Okay, we're going to talk today about financial management. In my experience, I've spent a little bit over 40 years in business, and mostly in restaurants and hotels all over the country: Chicago, San Francisco, Boca Raton, Florida, Dayton, Boston, and here in Cleveland as well. And I can tell you that one of the lessons that I've learned after being in business for so long is the 3 most important things to the success of a business are: know your customers, know your vendors and employees, because they support your business in 2 different ways. And the third one is know your numbers. You need to understand the financial health of your business on a regular basis, daily, weekly, monthly, whatever works best for you. I can tell you at a hotel and at a restaurant, that we would know our daily labor cost. We would know whether we made a profit for the previous day. We would understand all that, because we never wanted to find out that, whoops, we made a mistake that we couldn't correct in the short term. And so know your customers, know your vendors and your employees, and know your numbers. Today, we're going to talk about understanding your numbers. So the first thing is, what is the importance of financial planning? Then we're going to go to financial and managerial accounting. What's the difference between the two? Because there are 2 types of accounting. The 3 most important financial statements, we're going to spend some time on those. We're going to talk about what are fixed operating expenses, forecasting sales and units and prices, and then understanding financial information. What's in the income statement, cash flow statement, balance sheet, and some, we're just going to just touch on some diagnostic metrics, things like, what's your break-even point, and a few other simple things. Okay, so let's talk about financial planning and goal setting. Why are we doing financial planning and goal setting? Well, if you don't have a goal, any road will take you wherever you want to go. Okay. The problem is that you won't know if you've reached your goal if you don't have a goal, and you'll just keep moving, without a sense of direction. So the first thing you want to do is establish your personal income goals. And that's always really important. A lot of people say to me when we're talking about financial planning for their business, I have enough money to live on for 2 years. And, I come back and I say, is that really the case? Are you sure that you don't need to pull income from your business, or you're only going to pull minimal income from your business for 2 years? Make sure you've got the right resources. So match your personal income goals with a financial plan to achieve them. At the end of 2 years, everybody ought to be able to be making a living from their business, and hopefully even sooner than that, but certainly no farther down the road than 2 years. So set an income goal for yourself, and then see if the plan actually gets you to where you want to go. Another reason for financial planning and goal setting is gain a better understanding of the financial risks and rewards. About half of the clients that I work with, when we do the first pass on their financial plan, they realize that there are more risks involved than they anticipated financially. Okay, they've done a SWOT analysis, and I know you learned a lot about the SWOT analysis in previous simple steps. But it's one thing to write out the risks. It's another thing to actually see them in numbers, and it's really important that you understand that. The next point is identify early development and startup costs, ongoing operations expenses, and funds needed to finance the business. And this is one of the areas that's absolutely critical. One of the major reasons for businesses failing in the first year of operation is that they are underfunded. They did not understand how much money it was going to take to actually keep the business going until they were able to stabilize it and had a customer base that they could rely on. Recently, I had a client who opened a restaurant, and in her original proposal to get a loan, the loan was turned down because the lender believed that they did not have enough operating capital, which is part of the startup costs, to sustain the business for 4 months. And the lender believed that this restaurant was going to need 4 months until they got a customer base in the restaurant that was consistent enough to sustain the restaurant. And so it actually got turned down, and they told us why. We went back, redid the numbers. The amount of the loan actually increased, and the bank was actually happy with it because they thought we took a realistic approach to what had to be done to fund the business. Finally, it's important to have a plan to help guide the business decisions and monitor the results. If you set up a plan and say, at the end of year 1, I'm going to make $10,000 in revenue and $1,000 in profit, you have something to measure against. If you just say, I'm going to start a business and I hope to make money, you don't have a plan to run against. You won't know if you're going to make money as you go along. A lot of businesses are seasonal. A lot of businesses take a long time to actually start up and get traction with customers. A lot of businesses run into other issues, such as vendors refusing to deliver products to you unless you pay at the time of order because you haven't established a credit rating with them. And so there are all kinds of issues that have to be done to address. in order to be successful. So you notice here at the bottom, it says, businesses don't plan to fail. They often fail to plan. So we're going to talk about the financial side. You've already looked at the business plan, and now we're going to look at the financial side. So as I mentioned before, there are two types of accounting: financial accounting and managerial accounting. Financial accounting is a backwards view. What happened last month? What happened last quarter? What happened last year? It's the process of recording, summarizing, and reporting a company's business transactions through financial statements. It's a historical look. Okay, so again, you're looking backwards. What did we do yesterday, last month, last quarter, last year? Managerial accounting is a forward-looking view, is the practice of using accounting information from revenue to production inputs and outputs affecting the supply chain internally in support of the organization-wide efficiency. This is a fancy definition for looking forward and planning what you're going to do next financially. And in order to do that successfully, you need financial accounting. Now, when you're first starting out, you don't have a history. So you're going to do the very best you can to estimate what your costs are going to be. And that's going to be your financial plan that you plug into managerial accounting. But as you progress each month, each quarter, you should go back to the financial plan and see if you planned properly. Did you exceed your revenue goals and you exceed your profitability goals? Or did you not hit your revenue goals? Did you not hit your profitability goals? Do you need more money? And let me assure you that lenders get very concerned when you come back to them and say, I need another $10,000 or $20,000 to stay in business. So you really need to watch that. Through managerial accounting, you will go back and review your numbers that you had in your plan against what you actually performed to find out what is right and what is wrong, take advantage of the things that are right, and try to fix the things that are wrong. Okay, financial planning process. Clearly write out your business and personal goals. The first time I sit down with a client, whether it be virtually or in person, however it is, one of the very first questions I have for them is, what are your personal goals in relationship to your business? And what are your business goals? And I will tell you, the majority of my clients, first time around, haven't really thought these things through. And so by the time session 3 or mentoring session 4 come up, they know what they've refined and identified what their personal business goals are. I want to make $100,000 in 3 years. Okay, that's it's definitive. We know it's in 3 years and we know what the amount is. Okay, I want my business to have 200 consistent customers. I want to have $100,000 in revenue at the end of year 1, and that's all business goals. So you need to think about your personal goals and your business goals, and financial planning will help you in that process. You need to draft a business plan that achieves those goals, and we've already talked a lot about that in previous Simple Steps sessions. Create a financial model that supports the plan. SCORE has a really good financial workbook, and I'm actually going to show you some tabs out of that workbook. If any of you are not familiar with Excel, it'd be a good idea to get familiar with the very basics of Excel. If you're going to use the SCORE financial plan, if you're going to use another financial plan, for example, Life Plan, which is a very good program online, you might not have to have a knowledge of Excel. Or other online plans, you usually have to pay for those, whereas SCORE's is free. But you need to create a financial model that supports the business plan one way or another. And then test the plan in the financial model. Are we actually going to make money? I will tell you that the majority of businesses that start up do not make money in the first 4 to 6 months. And so, if you're planning on drawing a salary from the business, you need to keep that in mind. Most restaurants don't make money in the first year because it takes that long to really establish a consistent customer base. Hotels, convention hotels, and I've worked in several of those, often take as much as 2 years because of very difficult startup costs and the fact that conventions and large meetings, which are the bread and butter of those businesses, often booked 2, 3, 4, 5 years in advance. When I was working in Florida, we had bookings more than 10 years in advance. So it takes a while to build your customer base, but test the plan to see if that actually makes sense. Then revise your goals and plan as necessary. And that's based on, what did the test show us? Do I need to sell more product A? Have I overestimated product B? Whatever it happens to be. Is my labor right? Do I have too much labor? Is that a problem? And all of a sudden, I could be profitable, but I've got to be more efficient with my labor. Another example of that is I have a new client right now, and the first thing that we're working on in the client's financial plan is a staffing guide. You're going to be open 7 days a week. You can only be there 6. Who's going to open and close for you on day 7? And how many people are you going to have in your store each day, and in what assignments? And so we're working on a staffing guide right now. Finally, revise the financial model as necessary, and then make sure that your goals, your plan, and your financial model all fit together. Remember, the numbers out of your financial plan, your profitability, and what you're asking for if you're going for a loan, all have to match and be supported by your business plan. They're going to be in the business plan. They're going to be in the executive summary, which is the very first section of the business plan. And then toward the end of the business plan, there's a whole amount of detail that you'll have to put in on financial management. And so the whole thing has to work in harmony. You can't say I need $10,000 in your executive summary and then show a $50,000 loan in the financial plan. It just doesn't work. So the whole thing has to work together. Okay, so let's talk about goal setting. I like to use SMART goals, and SMART is an acronym. It's specific. It accurately describes what you want to achieve. Measurable. Are there clear metrics? Have we made this goal or haven't we made this goal? Achievable. Is it realistic? But there may be a little bit of a stretch in it. So, for example, if you're convinced that you can make 100,000 revenue, bring in $100,000 in revenue to your business in year 1, maybe your goal is $110,000. But in the back of your mind, it's really 100,000. But having a little stretch and pushing hard to achieve that stretch goal, there's nothing wrong with that, and normally it's very positive. Relevant. Is it important to the success of your business? A lot of first-time goals, as I've written or reviewed them with my clients who have written them, don't really focus in on what's relevant to the business. And if you think about what I mentioned to you before, know your customers, know your vendors and employees, and know your numbers, that really tells you everything that you need to know about writing a relevant goal. And then time bound. You can't leave it open to say, I want to have $100,000 in revenue. We don't know if that's next week, next month, or next year. So we want to make sure that it's time bound. So I gave you an example here at the bottom. By the end of the year, by the end of year 1, my business will have at least $50,000 in revenue $10,000 in net profit, and have a customer satisfaction rating of 9 out of 10. Okay, so you don't need something for each one of these acronym letters. You don't need something a sentence for specific. You don't need a sentence for measurable. You don't need a sentence for accurate. One sentence should cover the entire goal. Okay, or you could actually break it up. You could say by the end of year one, my business will have at least $50,000 in revenue. And then you can have a separate one saying by the end of year one, my business will have $10,000 in net profit. And you could have another one saying at the end of year one, my business will have a customer satisfaction rating out of 9 out of 10. And you could also say something for your employees at the end of year one, I will have no more than a 15% turnover of my employees. So there are all kinds of ways of writing out SMART goals. But SMART goals, the reason why I like using this is it's definitive. You can actually measure and understand exactly what the goal is and whether you achieved it or not. Moving right along, let's talk about the 3 most important financial statements that you're going to encounter. The first one is the income statement. It shows you your company's income and expenditures. It also shows you whether the company is making a profit or a loss at any given period. So you're going to look at the income statement, and I'm going to show you an example of an income statement shortly. And you're going to be able to look at that and say, I made money or I didn't make money during the period the financial statement covers. The next one is cash flow statement. It summarizes the amount of cash flowing into and out of the company. This includes all cash inflows the company receives from its ongoing operations and external investment sources. So when we say external investment sources, for example, if you're getting interest on a bank account. So the cash flow statement basically says I have more money coming in than going out, or I have more money going out than coming in. The cash flow statement and the income statement are similar to each other, but there are some things included in the income statement that are not cash, but are legitimate business expenses. And I'm going to go into that in a little bit more detail once we get into the actual statements. The balance sheet is a snapshot. It's a snapshot of your company's assets and liabilities and your equity. In other words, what your interest in the company is worth, and that's what equity really means, at any specific point in time. Balance sheets are normally not produced except for maybe monthly or quarterly, and then at year end. I will tell you that if you're going for a loan for any of the for your business, all 3 of these financial statements will be required by your lender. And the last comment down here, all 3 of these are used in both financial and managerial accounting. You're going to use, historical income statements, cash flow statements, and balance sheets, to plan what your future will be financially. So you're going to look backwards, look at the trends, and then do your forward planning based on your history. Next, so what is an income statement? Again, it shows the company's income and expenditures. It also shows whether a company is making a profit or a loss for a given period. I'm going to show you now what a simple income statement will look like. So I'm going to stop sharing for a moment, and then I'm going to start sharing again. Okay, here is a simple income statement. And you notice down here at the bottom of the screen, Anita, are you seeing this?
Yes, yes.
Okay. Um, Down here at the bottom of the screen, it says income statement year one. The financial plan that you can get from SCORE, by the way, actually goes out 3 years. But at the very top, you notice that there's a revenue section, and this particular financial statement has allows you to do 12 up to 12 different sources of revenue. So when you're thinking of your products, think of sources of revenue. Okay. And then the second section is your cost of goods sold. What does it cost you to make those products? And these are direct costs. So, for example, I like using restaurants. I think it's an easy thing to understand, even if you've never run a restaurant. So let's say that you're selling a hamburger. So up here on line one, we would have hamburger, okay? And we would say this, I sell a hamburger and I sell it for $8 and that's my revenue. But down here, my cost of goods sold would be the ingredients for the hamburger. So you have the hamburger meat, you have the lettuce, you have the tomato, you have the bun, maybe there's a pickle involved in it, maybe a slice of onion. Maybe it comes automatically with French fries. So you would cost out all of those ingredients, and that would be your cost of goods sold for the hamburger. Next, then, that gives you a gross margin. In other words, what the gross margin is your gross profit from selling the hamburger. It's the revenue minus the actual cost of the ingredients. Revenue minus the cost of the ingredients. Let's say that you're a dress manufacturer. The revenue would be what you sell the dress for. The cost of goods sold would be the cost of the cloth and the threads and maybe anything else that you're putting on the dress to make it fancier, maybe a belt or beads or whatever it happens to be. So that would be your cost of goods sold, and that gives you your gross margin. Then you add in your direct payroll. And what I mean by direct payroll is if you're in a restaurant, it's the cost of your server and it's the cost of the kitchen crew that prepared the hamburger for the guest. Okay, so that would be your payroll. It does not include payroll that you cannot distribute. So, for example, if you're running the restaurant, you are not going to be paid 6 cents for every hamburger. It just doesn't work that way. Your salary is going to come out as a general expense to the business. If you're doing the dress manufacturing, you're not going to be, taking out 50 cents and paying yourself for every dress. And the reason why is you've got other responsibilities besides that one dress. You've got the marketing and you've got the sales and you've got to make sure the website is up to date. And you've got all these other things that you need to do, just like the restaurant manager or the restaurant owner. So this is only dealing with direct payroll to the products that you're selling. And then you've got your general operating expenses, advertising, car and truck expenses. So if you do delivery, for example, gas, oil, tires, wear and tear on the vehicle, all that would be in there. Commissions and fees. If you're selling through a third party, you've got commissioned salespeople out selling your products or your services. That would go on this line again, because you're paying them not for one hamburger or for one dress. You're paying them for the bulk of what they're buying or selling rather. Contract labor not included. Let's say that you have a short-term contract with a company to do some work for you. Okay, maybe you're outsourcing your dress designs, and so you hire a company, and in 2 months they come up with 10 dress designs for you. That would come on this line. They are not employees of yours. Okay, so that would be contract labor. Insurance, other than health insurance is covered in your payroll cost. Whereas this would be things like general liability, fire, damage, maybe business interruption insurance. Some businesses have to be bonded, and so this would be bonding insurance, things like that. Legal and professional fees. This would be your lawyer, your accountant, any other professional help that you might be getting. Licenses is generally business licenses. So if you need licenses for your vehicles, it would be that. If you're running a restaurant, you need health license. Food truck, you need a health license. All this kind of thing. Any kind of business licenses that you need would be in here. If they're going to cost you anything. Office expense would be general office expense. Okay, so this would be things like stationery, business cards, miscellaneous things like that. Then rent of equipment and vehicles. If you're renting them, if you're not leasing them, just need to do something here real quick. If you're leasing or renting your space, you don't own your space, you're just leasing your space, then your rent for that space would be on this line. Repairs and maintenance is next, and then that would be any repairs and maintenance to your facility. General operating supplies, and bank and credit card fees. A lot of you will be using credit cards and or accepting credit cards, and those fees range anywhere from 1 3/4 to 3%, and so you need to account for those. If you need to do any travel, goes on this line. You pay for your utilities, and then any other costs that you might incur, you see here. And that gives you your total operating expenses, okay? So you subtract your total operating expenses from your gross margin, and just come down here. And that gives you your operating expenses, or pardon me, your operating revenue before other expenses. Now, I'm going to skip over a couple lines because I'm going to come back to these in just a moment. If you're paying interest on your loan, that would come here. If you're paying the principal on your loan, that comes here. So this would be interest on your loan. This would be principal on your loan. Any credit card debt. We really discourage credit card debt for startup businesses. But in some cases, you may need to do that. You may need short-term funding like $5,000, to do something that you need right away, and you don't want to go back to the bank. Credit card is good, but you need to pay that off as quickly as possible because credit card rates can be as high as 29%, whereas a bank loan could be 8, 10, 12%. So it really is better. And then again, here you can see, vehicle loans, if there's another kind of bank loan that you're dealing with. One of the things that we recommend is that when you negotiate a loan, have an open line of credit to go with it. And that's basically just a subsidiary loan that you would use for short periods of time if you don't want to use a credit card, for an immediate short-term cash infusion to make sure that you're able to make things work properly. And I'll show you an example of that in the cash flow statement in just a minute. And then, if you've extended credit to somebody, and we really discourage that, by the way, have them pay by credit card if they can't pay you by cash or check. But if you've extended credit to somebody and they're refusing to pay for whatever reason, there's going to be an expense there because you're going to have to write that off eventually. So that goes here. Let's talk about lines 60 and 61, which are amortization and depreciation. I'm going to start with depreciation. And let me use the example of your car. all of us have cars, or most of us have cars, and we know the day we drive the car off the dealer lot, the car is immediately worth less than it was when we bought it. So a year down the road, you may have spent $30,000 on a car, but today it's only a year later, it's only worth $25,000. Well, the government allows you to recognize that difference between 30,000 and 25,000 as a non-cash expense. And the reason why it's a non-cash expense is because you paid the $30,000 up front. The depreciation only applies to assets that you actually have bought, not that you lease. So, for example, if you're leasing a sewing machine for your dressmaking business, you can't depreciate that. The company that's leasing it to you can depreciate it because they own it. So let's go back to the vehicle. If you paid $30,000 up front, and the car is now only worth $25,000, there's a depreciation value in there, and that's a non-cash expense. And you're allowed to recognize that on this line. Okay? Amortization is similar to that, but it only applies to your startup costs for your business. So, for example, you build a website, and that costs you $5,000. And you bring in staff 2 weeks before you open your business to train them. That payroll is a legitimate pre-opening expense, and you're allowed to write it off over a period of time. You've already paid for all of this. You paid your $5,000 for your website, and you've paid your staff for 2 weeks in advance before you even open the doors. The government will allow you to write that off, normally over a 1, 2, or 3 year period, depending on what the expense is. For depreciation, items can be depreciated anywhere from 3 to 20 years. An example of a 3-year write-off might be your computer in your office. An example of a 20-year write-off might be the building that you're in if you own the building. Cars are sometimes 5 years, and if you're in a restaurant and you have an oven, maybe that's 7 years. The government has a schedule of what depreciation value they will allow you to depreciate over a certain period of time. And that's one of the reasons why you need an accountant, because the accountant can actually help you and work with you on this. So you subtract out all your other expenses. And I know I'm going very fast here, and folks, I do apologize, but we have to get through the entire presentation, okay? And you'll have the recording, so you'll be able to go back and hear it again. And your SCORE mentor can definitely help you with this. So what you're going to do is you're going to total all your other expenses, and then you're going to subtract that out from your income before other expenses, and that's going to give you your net income before taxes. And then if you have any income tax for your company to pay, that will appear on this line. And then finally, you have your net profit. And that's really your bottom line. When somebody says, what's the bottom line? That's what this is, okay? It is, did you make a profit after all your expenses or not? Okay, I'm going to stop sharing again, and we're going to go on to the next slide. Okay. Anita, we're back in business? Yeah, okay. The next financial statement we're going to look at is the cash flow statement. And the cash flow statement is similar to the income statement because it identifies a lot of different things, but it summarizes them in a different way. And we're going to walk through this. It summarizes the amount of cash flowing into and out of the company. This includes all cash inflows as a company receives from its ongoing operations and external investments. And again, remember, external investments for you really means any interest that you're getting off of your bank account. So let's go now and look at what that would look like. Okay, so we're going to use an example here. Okay, so here's a sample cash flow statement. Okay, it starts with cash inflows. What kind of cash did I take in? And there are generally two forms of cash inflows. One is cash sales, and normally credit cards are considered cash sales, but you might want to have a separate line item for credit card, just simply so that you understand the ratio of cash sale or credit card sales to other forms of revenue. But in this simple example, we've just called the cash sales, and that would include credit cards. And then if you're doing any accounts receivable means you're extending credit to your customers. You're not demanding payment upon delivery of service. And so that would be on line 11. So that's your total cash inflow for the business. Now, here's your cash out outflows, investing activities. And what that, in this case, you're saying, wait a minute, Richard, you said investing was income. Okay. Well, in this case, what we're saying is, did you buy a $5,000 CD for your business? Okay. So that would be another example of an investing activity that is really cash outflow, because you don't have access to that CD for the period of the CD life. Okay, so that's what that would be. New fixed asset purchases. Let's say that you're running a restaurant and you decide you need a new food processor. So this would take into consideration the fact that you're going to go out and buy a new food processor. So that's an example of new fixed asset purchases. Additional inventory. This would be an example of, let's say you're doing the dress manufacturing, and the dress season that you're currently working for is September, October, and November of 2024. Well, you're not going to make dresses in September, October, and November of 2024. You're going to make dresses in April, May, and June of 2024, so that you have them ready for September and October of 2024. You have them ready, your salesman can sell them, and you can ship them. So you need additional inventory before you actually make the sales. And that's what this line is for. Remember, if you're just buying something today and selling it tomorrow, that is not what this line is for. The restaurant hamburger would be a good example of that. This line is for things that you're not going to be able to sell for 2, 3, 4 months in advance. You're building up your inventory. You're getting your cloth, you're getting your threads, you're getting everything that you need together, so that and you're paying for it, so that when you need to ship to your customers, everything is ready to go. Okay, and then here's your general cost of goods sold. We've made X number of sales, and this is what it cost us. And then you have some other operating expenses. General operating, your payroll is an example. Taxes, financing activities. That's the interest on your loan, and then your loan payments. And again, that's the principal. Okay, and then if you're taking any money out periodically of the business. So, for example, I have a couple clients who don't take a salary, but on the cash flow statement, they take out quarterly amounts of money to pay themselves, and that's perfectly acceptable. You'll have to report that is income to the government, and you'll have to pay taxes on it. But this would be owner's distribution. Another example is, let's say 3 years down the road, you're doing great, and every quarter you pay yourself a bonus. That would go in on this line as well. Okay. And then if you have a line of credit, you need to show the interest that you're paying on the line of credit, and then line of credit repayments. How much did I actually pay back to the bank on this line of credit, and then any dividends you're paying. This dividends line would really only be for investors. So let's say that you had two people that gave you $20,000 each to invest in your business, and you are paying them back dividends, on their investment. Well, that would go on this line. Now, it's really important here, and please follow me for a little bit. Let's say, and I'm going to go right back up here to the top. You notice that this line here says beginning balance. What that means is how much money did you have in the bank at the beginning of the period? So let's say in month one, you had $10,000 in the bank to begin with. Okay. And then, you add in all your revenue, you subtract out all your expenses, and this will show you your total cash flows here on this line. It shows you total cash flows. In other words, is this positive or negative? Did you have more revenue than you had expenses, or did you have more expenses than revenue? Okay. So that's the net cash flow line right there. Okay. Now, the operating cash balance, this is the minimum that you are saying in your plan you need at any given time. So let's say that you said to the in your plan that you needed a minimum of $5,000 in the bank at any given time to cover your costs. So you would see $5,000 there on this line, the operating cash balance. But let's say that the net cash flow was a minus $2,000. Well, if it was a negative $2,000, you subtract that from what you needed in the bank. That meant you only had $3,000 left in the bank. You would need to borrow on a line of credit the additional $2,000 to bring you to the $5,000 that you need. And so that ending line of credit would show up here. So this is what you need. And then if you need to draw down on your line of credit to get to that number, this is what you need. That's your ending line, ending cash balance for the month. And then this line shows you your balance of your line of credit. So for example, let's say that you borrow $5,000 on your line of credit and you don't pay it back for 3 months. Each month you'll see $5,000 here. And depending on what your interest is, you might see $5,000 here, you might see $5,100 here, you might see $5,200 here, depending on because you're if you're not paying the interest every month and you're not paying the principal every month, it's going to grow. I know this is a lot. It's like drinking from a fire hose, but again, you'll be able to review this. You'll be able to see the video, and hopefully it'll be make a little bit more sense to you. And again, your SCORE mentor can walk through this with you step by step, and you'll understand it a little bit better. I'm going to go back to the slide presentation. Okay, let's talk about the balance sheet. The balance sheet is a very, very simple summary of the financial health of your business at any given time. It's a snapshot. And again, you only need to look at it maybe once a month at the end of every month. Usually the end of the quarter, the end of the year is normally acceptable. There may be issues where you need to do it more frequently, but certainly the end of every quarter, the end of every year. And it's simple. It's a summary of the company's assets, the liabilities, and you subtract the liabilities from the assets, and whatever the difference is, that's the value of what you own in the company. That's your equity. Okay. So you see here the accounting equation: assets equals liability plus equity. And if any of you have ever taken Accounting 101, you know that that's exactly one of the first things that you learn. So again, let's go ahead and look at a typical balance sheet. And again, this is fairly simple, and we're going to go through it pretty quickly. Okay. But the terms may not be familiar to you. So it's important that we try to understand these terms. Okay. So current assets. What are current assets? Current assets are things that you can turn into cash very quickly if you need to. So for example, cash is cash. You know, you have that available to you right away. Whatever is in your bank account, your accounts receivable, believe it or not, can be cash. Okay, because that is money that people owe to you, and you can collect that money. There's also a way of leveraging accounts receivable for certain types of businesses where you actually sell your accounts receivable at a discount to a third party. They give you money for it, let's say 70 cents on the dollar, 80 cents on the dollar, whatever it happens to be. And then they collect the full amount of the accounts receivable. Dress manufacturers, that would be a great example for a dress manufacturer. If you're running a banquet hall and you extend somebody credit, which we don't recommend, but if you're doing that anyway, you won't be able to sell that accounts receivable. There's no company out there that would sell it or buy it. Inventory. If you had to liquidate the company or you wanted to sell off part of your inventory because it wasn't moving very well and you needed the cash for other purposes, you could sell off your excess inventory. Companies like Big Lots and there was a company called Thursday or Tuesday Morning. That's what they did. They bought TJ Maxx does this. They buy overproductions or inventories that haven't moved from retailers, other retailers, and they buy it for like 70 cents on the dollar. The company that owned it originally or the company that was selling it originally gets some money out of the inventory. So there's a value there. And then if you have any prepaid expenses, that can be a legitimate source of revenue back to you. And then any other initial costs. Again, this is really miscellaneous kind of a thing. So that would be your current assets of the business. Okay. And then you have fixed assets. Well, what are fixed assets? Fixed assets are land, your buildings, any leasehold improvements. So, if you're leasing space and you put up walls and you added, better lighting and, did a whole bunch of things to the space to improve it, that would also be an asset because even though you're leasing the building, you're leasing your space in the building, that lighting is, you paid for it, it's actually yours. Any equipment you own, okay? Furniture and fixtures, any vehicles you own, and any other miscellaneous things. So fixed assets are not cash, but have value and have a life of 1 year or longer. And if you notice, all these items here have a life. They should have a life of 1 year or longer, and that's one of the criteria to make them a fixed asset. Okay, and then remember in the income statement that we looked at before, we saw depreciation. Well, that depreciation line has to be recorded as an asset to your company, and so it just appears here in the balance sheet as an asset to your company. It's just to make the accounting work. It's really no value, because if you were to sell that $30,000 car for $25,000, there has to be a way of showing the difference, and that's what this is for. So you would still show the up here, you would still show $30,000 on this line, but down here, you would show the $5,000 depreciation. And then you have your liabilities. And your liabilities are accounts payable. What's accounts payable? Accounts payable is what you owe others. So, for example, if you own the restaurant, the accounts payable would be what you owe the supplier for the hamburger, and what you owe the supplier for the bun, and what you owe the grocer for the lettuce, tomato, pickle, and onion. Okay, so that would be an accounts payable. If they're extending credit to you. If they're not extending credit, if you have to pay on delivery, then it wouldn't go into accounts payable. For the dress manufacturer, if you're able to get 30-day, 60-day credit on the fabric that you buy for your dresses, okay, that's accounts payable. It's what you owe. Commercial loan balance, that's what you owe on your commercial loan, okay? If you own the building that you're in, that's a commercial mortgage balance. Your credit card balance. Most of us have a credit card that we have a balance on. And so if you're buying things by credit card and you're paying the credit card off at the end of the month, whatever it happens to be, that would show there. Your vehicle loan balance and other bank debt balance. And then if you have a line of credit, the balance of the line of credit would show here. That's your liabilities. And then let's talk about equity. When you form your LLC or your S Corp, whatever you have to form for your legal structure, you're issuing common stock. The common stock may be to yourself or to your, you and your partner, whatever it happens to be, but there's a value to that. And for startup, most companies, start out with a $1 value, but as your company grows and becomes more profitable, the value of your stock increases. So we account for that on these lines. So you have your common stock, and then your retaining earnings. Your retained earnings are your net profit. It's just another way of saying net profit. And then any dividends that you paid yourself to your investors or the owner's drawn. Remember in the income statement, or probably the cash flow statement, we showed an owner's draw where periodically you would pay yourself a bonus or you would just draw because you're not drawing a salary. So that would be the value of your total equity, okay? And as long as your total equities and liability equals your assets, total assets, you have a balanced balance sheet, and that's where it comes from. Remember the formula. Assets equals liability plus owner's equity. So that's what the balance sheet is all about. Okay, I'm going to switch back to finance. We're going to talk about financial modeling now. Anita, did you want to step in on anything?
No, not. I think you're doing fine.
Okay, thank you. Okay, moving right along. We want to have some time for questions at the end. So that's why we're moving at this pace. So what is a financial model? I've showed you several examples of different financial statements that really come out of the SCORE financial modeling tool. So let's look at this. Okay, and I just need to do this real fast. Okay. Do that real fast. There we go. Um, financial model tool is a tool that represents your business idea in numbers. Okay, this is my business, and this is how my business is actually doing in the form of numbers. It helps you examine the feasibility of your numbers and evaluate variable factors. So, for example, let's say that you're in the restaurant business and you're selling hamburgers, and you decided that you don't want to offer just one hamburger, you want to offer four hamburgers. You're going to offer one with cheese, you're going to offer one with bacon, you're going to offer one with bacon and cheese, and you're going to offer one with guacamole, bacon, and cheese. Okay. Well, each one of those has a different cost associated with it, and therefore a different price associated with it. And the financial model allows you to look at this and decide, wait a minute, the one with guacamole and cheese and bacon on it, that's way too expensive to sell because my customers aren't going to buy a $20 hamburger. They're going to buy an $8 hamburger or a $10 hamburger or maybe a $12 hamburger, but they're not going to buy a $20 hamburger. So this allows you to check the feasibility of the cost and the price structure of what you're going to sell. So that's another reason why financial modeling is so important. Important. It's also a basis for tracking your progress. If you say in month 3, I should do $10,000 in revenue, and you look at month 3, once it's closed, once you finish with month 3, and you see you've only done $6,000 in revenue, or you see I did $15,000 in revenue in month 3, you want to know why. Your benchmark is your financial plan. If you only did 6,000, what was the problem? Were items not selling? Do you need more advertising to let customers know that your business is open? What is the issue? If you did 15,000, you want to go back and say, why did I do 15,000? What was my best seller? What was my worst seller? Should I change some of my items? Was my labor cost too high? Was my labor cost too low? I mean, do I need more labor? Was that something that's holding me back? I didn't have enough labor on the floor, and I couldn't generate the revenue because I wasn't producing my products fast enough. So the financial modeling will help you with that. And finally, it's a blueprint you can adjust over time to achieve your financial goals. And what I will tell you is when I set up financial statements, I always show the actual number for the month, the quarter, and the year. Next to it, I showed the financial plan number for the month, the quarter, and the year for each line item. And then I showed a variance. Okay. It was, $3,000 to the plus. It was $3,000 to the minus. And so I was able to literally track year to date, month, quarter, and year, exactly where I was at any given time. And by having the budget in there, that's my plan. So having the budget number in there, I didn't have to go look for other sheets of paper. I had it all on one sheet of paper. And it allowed me to go back and look at individual items to see where my costs were varying. Was my labor too high? I thought I was going to have a 30% cost of goods sold. That's 35%. What went wrong? What ingredients were in there that I need to either find another supplier to, or maybe do something different. So that's all part of it. Okay. moving right along. Steps to building a financial model. This is really important. First, identify what your fixed assets, operating capital, and sources of funding are going to be. Okay, so think of the balance sheet that I just showed you. You're going to look for your fixed assets. You know, am I leasing a space? Am I buying a space? What is the equipment I'm going to have to put in that space? What's my initial inventory? All that kind of thing. And how much cash do I need on hand to get the door open? What's my website going to cost? You know, to build it and get it launched. Well, other advertising. What are my licenses going to be? What are my legal fees going to be? All that. Just like the balance sheet, think of putting this together as your initial balance sheet. And then your sources of funding, those are your liabilities. Next, forecast your sales for the products or services you're going to be selling, along with what is it going to cost you, the unit of sales, the sales price, and the cost per unit. So, for example, in a restaurant, you might say hamburger basket. And a hamburger basket would be a hamburger with, you know, all the trimmings and fries. Okay, that's a hamburger basket. It costs the price is $8. The cost is $2. And so you know your unit of sales, a basket of food, what the cost is, $2, and what you're selling it for, $8. And you need to break that all down and understand your cost and price structure. Keep in mind that your pricing is impacted by your competition. So if somebody down the street is selling the same size hamburger and the same amount of French fries for $7, you might need to rethink the $8 price, and you may have to come in at $7 or maybe $7.50 to be competitive with the restaurant down the street. Okay. So you're going to forecast your sales. I'm going to do 100 hamburgers for the month or whatever it happens to be. Identify your staffing requirements. That's the reason why the first thing I ask my clients to do is identify their staffing requirements. Lay out a 7-day staffing plan. What do you need on Sunday? What do you need on Monday? What do you need on Tuesday? Whatever it happens to be. Okay. And look at your operating hours. Are you going to be open up 10 in the morning to 6 in the evening, or 9 in the morning to 6 in the evening? Or are you going to be like Target and open at 8 in the morning and close at 10 in the evening? So you need to think about this and plan your staffing accordingly, because next to your raw product, your staffing is going to be your most expensive cost. And in some cases, it may be the most expensive cost. If you're providing a service, for example, not a product, but a service, the service may cost you very little, but your staffing may cost you $25 an hour. So you need to balance that all out. Okay. And then forecast if you allow customers to have credit, how many are going to pay you within a month? How many are going to pay you in 60 days? How many are going to pay you in 90 days? This gets very complicated, especially for new businesses. Another reason why we say take a credit card, get paid by Venmo, any Cash App. Try not to extend credit in your business if at all possible. And then identify your other operating costs. Things like, your ongoing licenses, your ongoing legal and accounting fees, your operating office operating supplies, things like that. So that's all part of it. Okay. Next, identify your what your fixed assets are going to be, your operating capital and sources of funding. We've gone into this a little bit already. Remember, your fixed assets include your building, not your land. Or you can have your value of the land, but you can't depreciate land. You can only depreciate the building on the land, and that's important. You cannot depreciate land. So your fixed assets include building, your land, equipment, furniture and fixtures, any vehicles, anything that'll last one more year. Next, your operating capital includes pre-opening costs plus operating capital to sustain the business for at least 3 months. And the whole purpose of that is to give you enough money to run the business until you establish a consistent client base. And then sources of funding includes your equity. If you're going for a commercial loan, most lenders are going to require anywhere from 10 to 20% minimum to qualify for a commercial loan. So let's say that you need $100,000 to open your business. The lender is going to say to you, depending on the lender, you have to provide $10,000, $15,000, $20,000 of your own money. And you can get that money from your own bank account, or maybe you have a couple investors, and that counts. But before the bank will loan you the $80,000 balance, you've got to have $20,000 available to you. Okay. And so it's your equity, what you're contributing to the business, loans, lines of credit, and capital from investors. Okay. Now, I often get asked, well, let's say that I'm opening a restaurant and I've already bought an oven and a range and a food processor and a couple other pieces of equipment. Does that count toward my owner's equity? And the answer is yes. You'll include that in the total amount of what you need. Okay. But then the amount that you paid for the range and the food processor and the oven and, all the other equipment you've already purchased that are fixed assets count toward your equity. So that's important to know. Okay. And then forecast your sales, identify each item or service to be sold, a chicken basket, a hamburger basket, a prime rib dinner, a dress, party balloons, transportation service for people who don't have, transportation. Maybe it's for people who are disabled or who aren't feeling well, and you have a specialty business doing transportation for those people. Maybe it's home health care. There could be a lot of services that you provide. I have a client that does nursing staffing, and I have another client that does banquet server staffing, and those are services. So, identify each item that you're selling, determine the cost to provide that item or that service, and you'll notice here, normally your prices range anywhere between 25 and 50% of the sales price. It depends on the business. And some items, for example, in the restaurant business, alcohol prices might be 20 to 25% of the sales price. And so you kind of keep that in mind. Whereas if you're doing dresses, maybe the cost is 40% of the sales price. And determine the sales price for each product. Keep in mind that you need to think about the quality of your product vis-a-vis your competition, and then what your competition is charging. And then finally, forecast the quantity of sales for each product or service month by month. And this is the hardest thing that you will have to do to put together a financial plan if you have no history. So you're going to take your best guess based on your knowledge of your business. And that's one of the reasons why I always suggest that if you don't know anything about the business that you're going into, if you haven't had experience in that business previously, get some experience before you open the doors. You may find lenders may actually require that before they are willing to loan you money. Okay, forecast your labor, identify what you are going to pay yourself on a monthly basis, and identify how many full-time employees you'll need and how many by position on a monthly basis and what the hourly pay will be. Identify part-timers. And then if you have any contractors, be careful of contractors. And I have a special slide on this. Be very careful when identifying a worker as an independent or contract employee. The IRS is very strict about work rules for these employees who receive a 1099 form instead of a W-2 form. According to the IRS, people who are self-employed are considered independent or contract workers. However, Whether someone is an independent contractor or company employee depends on facts in each case. The general rule is that an individual is an independent contractor if the payer, you, has the right to control or direct only the result of the business and not what will be done or how it will be done. Okay? So, for example, let's take the example of somebody who is working for you in your food truck. And you're paying their wage, and you say, you prepare the hamburger this way on my food truck, and you prepare the chicken fingers this way on my food truck. You cannot call them an independent contractor. They are an employee because you are directing how that work will be done. If, on the other hand, you were to say to them, we serve chicken in the basket and we serve hamburgers in a basket, and all I want you to do is figure out how to get the food from the line to the service window so that my customers can pick up their food, and I don't care how it's done, then they can be considered an independent contractor. There are some other caveats to this. You need to work with your accountant to make sure that if you're going to take that approach, that you are within the federal and state laws. Okay? The earnings of a person who is working as an independent contractor are subject to self-employment tax. To find out what your tax obligations are, there's a link here for the Self-Employed Individuals Tax Center. You can click on that link and it'll take you right to the information that you need to know. Okay, and then finally, steps in building a financial model. The first one is forecast the other operating expenses that you're going to incur: advertising, operating supplies, licenses, legal fees, accounting fees, whatever it is, monthly rent, monthly utilities, insurance, whatever it happens to be, and just do a forecast on them. Some of these will be easy to figure out. For example, licenses. You know when your license is going to be due. Insurance. Excuse me. You know when your insurance is going to be due. You know when your monthly rent is going to be due. Advertising. You're going to figure out a whole advertising campaign and how much it's going to cost you to maintain that. You'll know what your website is going to cost you every month. So it's not as hard as you may think. Then put that all together, and you will have all the data that you need to create your financial model. And then I'm going to skip over that slide for just a minute. Let's quickly talk about a couple financial metrics. Number one is your break-even point. What the break-even point is the point at which your gross margin, you are taking in your sales minus your cost of sales, your cost of goods sold, is sufficient to cover your fixed expenses. So, an example, let's say that you're selling a dress and the dress sells for $100. Okay, your cost of goods sold is $25. Okay, that leaves $75 to cover your fixed expenses. Okay, so as long as you have $75 to cover the rest of your expenses from that $100 sale, you're at your break-even point. However, let's take another example. Let's say that it costs you your other expenses, your fixed expenses are $75, but your cost of goods sold is $30, and you're still selling your dress for $100. That means you're losing $5 for every dress that you sell. So your break-even point is $25, not $30. So you need to have that $25, and that's your break-even point. Financial ratios and industry benchmarking. There are a whole series of different financial benchmarks that your accountant can help you with. And there are a couple really good organizations to to get the data from that is national benchmarking. In other words, these organizations gather data in from all over the country in almost every industry you can think of, and will let you know what small businesses are as far as their expenses as a ratio or percentage of what their revenues are, and what medium-sized businesses are and what large businesses are. Dun & Bradstreet is one. Risk Management Association is another. Caution, to get this data out of D&B and out of Risk Management Association, you're going to have to pay for it. But there's a workaround with Risk Management Association. The Cleveland Public Library has a subscription, and they will let you use their subscription for Risk Management Association. Okay, so you can log in. A business librarian can help you with that. Anita, that's pretty much it.
Okay, we have at least one question here. Will you get into separate expense ledgers and suggest software to capture sales, timekeeping, etc.?
Okay, as far as the ledgers, those really support every one of those ledgers that you're thinking of, support the financial statements I showed you. And depending on your business, those ledgers will look differently to reflect the nature of your business. So, for example, the ledgers for a fast food restaurant might be different than a full service restaurant. Okay, and the ledger for a retail clothing store might be different than the ledger for the manufacturer of the clothing. So I didn't get into ledgers, but they support the income statement, the cash flow statement, and the balance sheet, especially the income statement and the cash flow statement. The balance sheet comes from the income statement and the cash flow statement. That's the data source for the balance sheet, the income statement and the cash flow statement. As far as software, there's a lot of different programs out there that can help you. Probably the best known is QuickBooks, but there's also Xero, there's FreshBooks. Almost all of this is online now. There are very few companies that actually provide you with the programming and your files on your computer. It's almost all cloud-based at this point. They're all good. The Akron chapter, I think, in the next week, I may be wrong in this, Anita, maybe is doing a workshop on QuickBooks and how to set it up. It's either Akron or Canton, one of the two. And that might be of interest to you. SCORE as a policy, cannot recommend one or the other. They're all good. What I can tell you is QuickBooks tends to be a little bit more complicated than, for example, FreshBooks. I think FreshBooks is really a simpler program. It doesn't have all the functionality of QuickBooks. So it really depends on what you're comfortable with and what you really need.
Is there a bookkeeping program that you would recommend for a food business?
Almost any one of those can be adapted easily. One of the other things is a lot of your in the restaurant and food truck business, your point of sale system really can do a lot of this for you. It won't produce the income statement or the cash flow statement for you. You would still need QuickBooks or FreshBooks or Xero. Xero is really more for Apple versus a PC. But the point of sale system, these have become very sophisticated, and there are a lot of really good ones out there. And they can provide you with a lot of immediate reporting and a lot of data that they can capture your food costs by day. They can capture your sales by item by day. Some of them, your employees actually log in and log out of the point of sale system and capture your payroll for you. So there are a lot of those out there, and you really have there are probably 5, 6 different brand names out there that are affordable and can do a lot for you.
Okay, can you provide one more example with service forecasting?
Sure. Let's say that you're providing transportation for people who are ill, and so you would need to identify how many rides per month you need to provide in order to break even. So let's say that you have two vehicles, you're paying a lease cost for those vehicles because they're going to be specialty vehicles. You may need, wheelchair access or some other kind of handicap access, and you need drivers, and those drivers have to be specially trained to drive those vehicles and to assist people getting in and out of those vehicles. Maybe there's a lift involved, and they have to know how to operate the lift. So it's just simply a matter of putting all that together and then saying, what's my market out there and how much can I capture of that market? So in order to do that, a good resource for that would be the American Community Survey from the Census Department, the federal government. That'll show you a general inventory or a general population for the service area that you want to work in. So let's call it Cuyahoga County. And it'll say, Cuyahoga County has 800,000 residents. And then from other sources, you should be able to capture roughly how many people need help services. United Way can provide you with some data. There are other resources that can provide you with data. And let's say that you've identified 5 competitors that do the same thing that you want to do. You can then say, well, right now there are 5 competitors. I'm going to be the 6th in the market. So in year 1, I'm probably only going to capture maybe 5% of the business. By year 2, maybe I'm going to capture 10% of the business. And by year 3, maybe I'll capture 15 or 17%, whatever it is, so that you get what is known as a market share, your fair share of the market out there. And that's how you would go about determining it. And then you would break it down on a month-by-month sales. Again, this is the most difficult part to do. It's real crystal balling. And I'm going to be honest with you, most of my clients, the first time around, we go through things and I ask them a lot of questions. Are you sure this number makes sense? Why does it make sense? Have you over forecasted? Have you under forecasted? I have a client right now who wants to open a duck pin bowling alley, and he only forecasted 8 rounds of bowling every night. And I'm saying, wait a minute, you've got 8 lanes of bowling, you've got 8 rounds of bowling. That means each lane is only going to be used once. You don't have enough usage here. So it's that kind of exercise that you're going to have to go through.
Okay, let's see. I'm new to entrepreneur, so my question is, how does an owner's draw work? Can you transfer your pay, or is it best to write a check for an owner's draw for tax purposes?
You one way or another, you're going to write a check to yourself. If you're doing it as part of regular payroll, you're going to write a check to yourself. But when you do it as part of regular payroll, right at that time, you're also going to be subject to the taxes, the payroll taxes that you're going to have to pay, workman's comp and state unemployment, and all the different FICA and all the different state and federal income taxes that you're going to be liable for. If you do it as an owner's draw, that means that none of the taxes are going to be taken out. And eventually, either through quarterly or annual income tax reporting, you're going to have to pay those taxes at that time. So it's really up to you. I tend to recommend putting it in as regular payroll, so you don't have to worry about at quarter end or at year end. You owe the state and the federal, and maybe here in Cuyahoga County, you own Rita, a total of $5,000, and you don't have the $5,000 because you've already spent it. So there's a real caution there to do that. Now, what you may decide to plan to do is not pay yourself for the first 3 months and then add yourself to the payroll. And I have done that with clients in a couple of occasions because the first 3 months they couldn't afford it. The business just didn't have enough sales in the first 3 months, but they had enough to live on. And at that point, we felt that they could actually progress. So it could be kind of a combination of both. But I tend to recommend not doing a draw unless it's absolutely necessary, or you're just, you're paying yourself a bonus.
What about S Corp as it relates to owner's draw?
An S Corp is a little bit more complicated than an LLC. Remember, you're in control on an LLC. There's normally, with an LLC, you can be the sole owner and you don't need a board of directors. I don't know all the ins and outs of an S Corp, so I'm going to tell you what I think I know, but I'm not entirely sure. With an S Corp, you're going to need a board of directors. And with a board of directors, they would have to approve a draw. It doesn't matter whether you're the CEO or the president or whatever. The board of directors adds a little bit of complication to it.
Right. Okay. Let's see. Support service at work, Department of Disabilities. I'm not sure exactly what that means.
Yeah, I'm not sure either.
I think this is from the same person who talked about service forecasting,
Okay.
so maybe you answered it. I'm launching a consultancy in construction and zoning. Any specifics relative to that? For example, pricing, consulting time?
Yeah, I would check my competitors real close. You may want to, as an initial entry tactic, price yourself a little bit less expensive if you can afford to do that, just so that you can be competitive in the market. You got to remember, when you're doing a startup, especially in a consultancy, because I actually did that at one point. Okay. I had, over 30 years of experience at the time, and people relied on my experience, but I hadn't been a consultant. And one of the issues with consultancy is you're spending, a third to maybe 40% of your time actually performing the consultancy, and then you're spending the rest of your time finding clients. And so you have to kind of balance that out, where the revenue is actually making sense with the time that you're spending finding new clients. So you need to balance out, should I price myself at the same as my competitors or a little bit less, so that I can use pricing as a way to draw in new customers? Or maybe you charge a little bit more because your services are that much more. Okay. You're doing added value services that your competitors aren't. So the pricing gets a little bit dicey. My suggestion is price shop your 5 or 4 closest competitors from a service quality and a range, an area that you're working with, Cuyahoga County or the state of Ohio, or Indiana, Ohio, Michigan, and Kentucky, and depending on where you want to serve, and then determine, am I doing value added so I can charge a little bit more, or am I not? Am I really doing the same thing, and I need to use a lower price to be competitive in the market?
Okay, I think we've covered them all. And so, Richard, thank you so much. This has been an excellent program. I think people really appreciate it. And so thank you all for spending the time with us. We appreciate it. I hope that you received the information that you were hoping to, and look forward to you next week. We have a session on finding funding for your business. So that should be a very interesting one as well. So enjoy the rest of your evening, and hopefully we'll see you next week. And Richard, thank you.